Welcome to Excel Finance video number 14. Hey, if you want to download this PDF or the Excel file that we'll be using for Chapter 3, you can click on the link below the video and go to the Finance section, the file Business 233 Chapter 3 or the PDFs for Chapter 3. Now, let's start over in the PDFs. Hey, Chapter 3, Financial Statement Analysis using Ratios. Now, ratios are used everywhere in almost all endeavors to compare numbers using division. And some of the things we learn in this chapter are not only awesome for finance, accounting, financial statement analysis, but also other fields also. Our topics: why use financial statements. As we talked about in earlier videos, accountants do not necessarily use cash flow numbers. Finance people are interested in cash flow numbers. And if the financial statements have been around for a while, are they relevant? So we'll talk about why we use them. We'll talk about problems with financial statement analysis. We'll talk about the vast majority of what we do will just be calculating financial statement ratios. Not only common size statements, but ratios. And then why do we use ratios to analyze financial statements? All right, let's start off with ratios and financial statement analysis. Financial statements such as the balance sheet and the income statement are accounting information, as we mentioned. Although financial managers would prefer market value information, and there's lots of market value information out there, and in fact, there's all sorts of different information. All right, but sometimes, we would prefer this, but accounting information is often the best we can get, right? And here's really what happens and why accounting information, financial statements, can be so important. Here's inside the corporation. Here's outside. People are out here: creditors, suppliers, customers, stockholders, governments. Managers are inside. They control the assets, the accounting records, all sorts of things. Now, presumably, we have independent auditors coming in and making sure, and in fact, that's why auditing exists. Auditors come in and make sure that the managers are following the regulation that the government creates for financial statements. The regulation created by the government is its sole intent is to make sure that good information comes out of here to all the people outside. Good regulation will and good incentives from various places will force the managers to create good accounting information. But accounting is the mechanism to get that information out. So financial statements convey information from inside the corporation controlled by managers to outside the corporation. Problems. So this is why we use financial statements, because a lot of times that's the best access we have to getting information. There's lots of other ways to get information, but that's one particularly good one, and that is the mechanism in the market to get information from inside to outside. All right, now problems with financial statement analysis. Hey, accounting. Accounting rules, right? That's problem enough. There's so much gray area in accounting. But accounting rules in the United States allow for different firms to use different accounting procedures. For example, in inventory, you could use the FIFO, LIFO, weighted average, or even other methods. Same with depreciation. So accounting rules themselves are oftentimes gray, and you can move around a lot within those rules. So ultimately, when you're looking at financial statements, you have to look at them carefully and go to the back and read the notes and see, oh, they're using LIFO for inventory. And then when you're compared to other companies, make sure they're using LIFO. Or if they're using FIFO, then you have to take that in consideration. Number two, international rules can be very different. So when you're comparing financial statements from different countries, you have to be aware of the rules from each of those countries. Conglomerates like GE, right? They have all sorts of component businesses. So who are you going to compare GE to? There's no other business exactly like them. In that case, you look at the component business and then find a parallel similar business outside, and you can compare that. Analysts may use different techniques for calculating ratios. Not may, it's analysts do use different techniques. With ratios, you always have to know how the ratio is being calculated. You look at the numerator and the denominator, the top, the bottom, and see what did they use to get those numbers. And number 5, not even on this list, kind of up here with accounting, but number 5 is accounting is gray, and accountants and financiers do all sorts of tricks. Obfuscation is the word. In fact, obfuscation just means to gray out or make so difficult to understand. Not only can you do it with accounting and even simple things. We have an example coming up later in this chapter with current ratio and how we can change the numbers a little bit to manipulate them. So you have to watch out for that. In addition, of course, financiers can do all sorts of tricks to move things around. You've heard of off-balance sheet financing. All sorts of tricks to actually hide debt. One trick that people used in the recent financial crisis was they had a bunch of debt, and then they bought insurance on the debt. And then that meant for some reason they could not show it on the balance sheet. Many other tricks that people do. So number 5 is here, accountants and financiers try to trick you. Now, if you're doing this as a profession, your job is to figure out where they're trying to trick you and then undo those numbers and really analyze what you see. So those are problems. But again, oftentimes, that seems to be at least the best starting point, is that information that comes out, that accounting information. All right, ratios, totally exciting. And what we're going to do here first is just talk about what is a ratio. We have a great example, the current ratio. Now, our example down here, but before, what is a ratio? A ratio shows a relationship between one number and unit and a second number and unit using division. Example, find ratio of current assets to current liabilities. Now, in chapter 2, we talked about working capital, right? Current assets are all of the assets that could be converted to cash within a year. Current liabilities are all of the debts we owe within a year. So really, you think about it as current assets, cash coming in. Current liabilities, cash going out. So we want to compare these. Working capital, we just took current assets and subtracted current liability. But there's a ratio called the current ratio. Now, we'll talk a lot about the current ratio later. Here, we're just going to talk about what is a ratio. So we're just going to take it. OK, this will be current assets, and we're going to represent it as CA, $200. Current liabilities, CL, $100. Now, before we do this ratio, let's look at this ratio of something to something else. Every time you see this construction, you know the of part. You come down here. The of part always goes in the numerator. The number is 200. And the unit, you always got to think of the unit. Now, I'm going to show you here how to, with this simple one-page guide to understanding a ratio, how you can understand any ratio that's given to you. And the way you do that is you make sure you put the right thing of into the numerator and the to part, to current liabilities, in the denominator. You understand the number and the unit. Most people do their ratios and they leave out the units. This book we're using doesn't talk about the units. The business math class, the accounting class I teach, they never talk about the units as much. But for us, we're always going to explicitly leave the units here. All right, and so the same thing here. 2 goes in the denominator, number, and you better list the units. So all we have is $200 of current assets in dollars and $100 of current liability in dollars. So when you do the division, since that's what a ratio is, the trick is you take out your Excel. You say 200 divided by 1. Most of us just go 2. Our book goes 2. But if you leave the units in the numerator and the denominator, you have the meaning. So really, you don't have to memorize all those meanings in the textbook. You just go, oh, this is $2 of current asset for every $1 of current liability. Now, since this is cash going out, cash coming in, and this is cash going out, that means we're covered pretty well. $2 of current assets for every $1 of current liability. Now, I can't stress this enough. The trick to ratios, when we get to asset turnover ratios and days payable and all sorts of other ratios, return on assets, return on equity, keep that 1 here and it will tell you what the meaning is. Keep those units there and it'll tell you what the meaning is. For every $1 of CL, we have $2 of current asset. Now I want to go over and do an example. We're going to go to our Excel workbook. So there it is, same thing right here. I'm going to do my calculation here. Equals that divided by this. It shows us 2. Now, what I'm really going to do right here, just since we're just learning this, is I'm going to put $2 of current assets divided by $1 of current liabilities. And there's the meaning. You just say, and you could say it in either direction. I have $2 of current assets for every $1 of current liability. Or you can say it the other way. For every $1 of current liability, $1 of short-term debt I have $2 of current assets, or $2 of these assets I can convert to cash quickly. All right, now this is silly here. Look at this. Our next topic is common size financial statements. And actually, this whole video is just kind of a brief introduction to ratios. The next number of videos will go into great detail about solvency, liquidity, profit ratios, etc. But common size financial statements is a good topic to talk about when you're learning about ratios. A standardized financial statements presents all items in percentage terms. Balance sheet and income statement are the ones we're going to see most commonly, right? Balance sheet items are shown as a percentage of total assets. That means you have to compare every item on the balance sheet to total assets. Total assets will be the denominator. Income statement, you show every single item as a percentage of sales, or sales will always be the denominator. Now look at this. Isn't this ridiculous? This is how we would do it by hand. Here's our income statement. Net sales, cost of goods sold, other expenses, EBIT, earnings before income and tax, interest, tax, net income. You take every one of these numbers and you divide it by the same number every time. Okay, when we get over to Excel, our absolute cell references are going to help us there. So here's all of our answers. Well, that's 1, right? No, because net sales divided by net sales. Anything divided by itself is 1. And then you get these percentages. Now, what is so beautiful about this for the income statement is that you can say, for every $1 of net sales, or we have it listed as 25%. Let's go over here. It's easier here. For every $1 we have of sales, 25 cents is used up for cost of goods sold. 15 cents is used up for other expenses. 60 cents is our earnings before interest and tax. 10 cents is our interest. 17 cents is our tax. And 33 cents is our net income. Okay, so usually when you get used to it, you see these in percentages and you automatically think that. As soon as you see this income statement percentage, right, for every $1 that we sell in our store, 33 cents is net income. Let's go see how to do this in Excel. Right, so here's that same little financial statement. Now, remember, every one of these numbers divided by the same number there equals 1, 2, 3 cells to my left, divided by B9. Now, from chapter 00, remember that B9, we need to lock that, so we hit our F4 key. And it puts the $2 signs in. That means that's locked. This one's always going to be a relative cell reference as copy down. This one's locked. So Control-Enter. And then I'm going to do 2 things here. I already have some formatting here. So when I copy this down, I'm going to point to my little fill handle. When I see that crosshair, click and drag. Now, over here, if I click, you can see it wiped out the formatting, because when you copy a formula, it copies the formula and the formatting. So I'm quickly going to point to my Smart tag and say fill without formatting. And now when I click over here, you can see I retained my formatting. And there you go. That is just awesome. Not only is this great for saying things like 25 cents out of every dollar is consumed for cost of goods sold, but you can also use these to make predictions, right, for next year. Now, usually you don't base it on 1 year. You take an average of many years. But another great use for common size financial statements. Other uses and for common size financial statements we'll look at going forward. Let's go back to our PDFs. Why do we use ratios to analyze financial statements? There's a bunch of reasons. We have 1, 2, 3, 4, 5, and then 5 we'll talk about common size financial statements. The first one, and the obvious one, is we can see relationships between numbers. So for example, if we have net sales and net income, right? Oh, we just did this calculation, right? This was part of the common sized income statement. Our profit margin, it's always going to be net income in dollars divided by net sales in dollars. So 200, keeping the units, divided by 5,000, keeping the units. And what do we get? 4 cents of net income for every $1 of net sales. That is another way. We just talked about it from a slightly different point of view. We said, oh, 4 cents of every dollar we sell goes to net income. But here we can see it from a slightly different point of view, right? $1 of this yields 4 cents of that. So net income. So that means what? 4%. For every $1 we sell, we earn 4 cents in profit. Again, that's looking here. For every $1 we sell of net sales, we have 4 cents. Let's go over. So, and this is again seeing the relationship between numbers. What are the two numbers? Every dollar that comes into the cash register. What's the number up here? Our net income, our accounting earnings. Now I'm going to come over to Excel. All right, let's do the calculation. Equals the 200 of net income divided by our 5,000, 0.04. What does it mean? Too bad I can't type. So 4 cents of net income for every $1 of net sales. All right, number 2. These are the why we use financial ratios. Number 2, we can see trends over time without distortions of different numbers. So here it is. These are and ultimately ratios for us. You can't really do a single ratio and have it mean much. You do a ratio and then another ratio the next year and another ratio the next year, and then you compare them and see the change. Or you do a ratio for your company and the average for the industry, or your company and another company. So here's an example. Internally, we see cash in 2001 is 200. Total assets in 2001 are 2,000. But in 2008, a bunch of years later, we have cash of 600. And our assets are 5,000. Now look at this. It's grown by 3 times. 200 times 3 is 600. Right? So it looks like we have 3 times as much cash. But forget it. That's not really the case if we look at it in terms of all of our assets. Right? When we do the ratio, 2001 cash divided by 2001 total assets, we ended up doing, that means 200 divided by 2,000. We got 10 cents cash for every $1 asset, or 10%. Here, 600 divided by 5,000, we got 12 cents of cash for every $1 of total asset, or 12%. So what? it looks, if we compare the naked numbers, looks 3 times bigger, but forget it. In terms of the cash in relation to assets, total assets, it's 10% compared to 12. So although the cash is 3 times bigger in 2008, we get a percentage change of not very much. So although, and you can see, oh, I did spell it right. I hope I spelled it right. You know, the problem with these handwritten notes is I don't see the squiggly red line. So although the cash amount in 2008 is 3 times bigger than 2001, as a percentage of total assets, it's only gone from 10% to 12%. There's not been much change. Now let's go over to Excel. Again, we're going to take two different ratios, 2001 cash compared to total assets. And again, here, 600 divided by 5,000. And so the point here is that we can understand relationships between numbers better when we use these ratios instead of comparing just the same numbers. Let's look at another great example along the same exact lines. We can compare small and big companies without the distortions of different numbers. That's basically the same thing here. Here's Microsoft cash. This is 2006 data. 23 billion. Microsoft total assets, 63. Google cash, 11 billion. Google total assets, 19 billion. We can compare these two right here. Looks like Microsoft has way more cash. Now, they do have more cash, right? But what about as a percent of total assets? Here we see Microsoft is at 37. 23 divided by 63 is about 37, and 11 divided by 19. So Google in 2006 had 58% of their assets in cash. They were probably on the hunt. They were buying lots of new assets, so they had a lot of cash. That's a huge proportion. Now, we mentioned this earlier, but cash, what can you do with cash? If you put it in the bank, what can you earn? A couple percent. Or maybe if you have a lot, billions of dollars, you can put it and earn, whatever the market rate is, more than just your savings. But that is, so you earn 5% on 11 billion. Really what you want to do is you want to go out and buy your long-term assets. Those are the assets that determine your business, and presumably earn a much higher return than put it in the bank. So when you see this much cash, there could be a couple reasons. Back then, it presumably meant that they were on the hunt to buy more assets. Now, during the financial crisis and after 2008, 2009, 2010, you see people with a lot of cash. The reason why is they're still scared. They're conserving cash because during the financial crisis, everybody ran out of cash. So they want to hold enough cash in case they get into trouble again. And maybe during this period right now, they're not sure what to go and buy. So the point here is we can compare different companies with percentages. Let's go over here, do that same thing. I'm going to, by the way, click in this cell. The number 23 is up there. If you go to Format Cells, right-click Format Cells or Control-1, you can see there's a custom format there. Anytime you put a 0, or if you want decimals, you could put 0.00. If you actually put some text, remember this is number down here in custom. If you actually put text, the text will show up in the cell, but not there. We shouldn't be too surprised by that, because here's a number format we use all the time, right? That $ appears there, but the number's not there. All right, so Microsoft equals 23 divided by 63, and Google is 11 divided by 19. Number 5. I sound like David Letterman, right? The top 5 reasons to use ratios. Ratio analysis and common size financial statements are a convenient way to look at and compare financial statements for different companies across time. Many people use ratios in financial analysis and common size financial statements, such as all of these people. Now, oops, I skipped over number 4. This example here is just a great example of why ratios and common size financial statements are so good, because you can compare different size companies. I skipped over 4, but number 5 is just everyone uses this kind of analysis. Now, remember, as in chapter 2, cash flow analysis, and this chapter 3, these are all, we're analyzing financial statements. So all of these numbers that we get are just like the starting point. If it seems normal, maybe we don't look much further. But anytime we see a difference or an exception called management by exception, we see something different, we're like, we better go investigate. But all these people use ratios. Creditors ask the question, should we loan? Right? They're using current ratio or something. Stockholders, are managers doing a good job? Maybe profitability ratios. Auditors, they use all sorts of ratios. Where do we need to look closely? Suppliers, should we extend credit? Employees, should we work for this company? Stockbrokers, should we invest? Investment banks, how am I going to cheat again? Oh, no. Investment banks, should we underwrite? Underwrite means, should we help them issue stock or issue debt? That's one of the big things investment banks do. Research analysts, is this a good company? Now, research analysts are the ones that dig really deep. But even research analysts, they can start with a financial statement and some financial statement analysis, and then they go and dig deep. Financial research analysts, I mean, they go and interview anyone. They're detectives, just like auditors should be detectives. Contract writers, every debt contract usually, oh, wait a second, not every debt contract. During the financial crisis, they didn't really spend much time writing the contracts. They just said, OK, I'll loan to you. OK, I'll loan to you. Remember, they didn't really check to see whether people had enough funds to pay off. But in normal times, debt contracts, for example, have lots of covenants. That means rules about what you have to do. So for example, they will have the current ratio. And the debt contract will say, if the current ratio gets below this, then you're in default and you have to pay us. It's not usually just the current ratio. It's other things. But that is one of the things that they can use. Now, I skipped over number 4. We can compare financial statements that are in different currencies. But be careful about the accounting method. So if we have company 1, equity is this amount. Total assets is this amount. So equity and total assets. Here, equity is 500. Total assets here, 1,000 pounds. Right? These are in dollars. These are in pounds. And now, I rigged this one here so they come out the same. But look at this. When we do the division, we get, for the dollar one, $2 of total assets for every $1 of equity. This is called a leverage ratio, because here's all of our assets. Here's our equity. This one has total assets is debt plus equity. So when you divide it by equity, it says, from every $1 of equity, how much assets do we have? 2. So there's how you get the meaning of it. But when you do a straight percentage, you're like 200%. Here, the same thing. In pounds, you get the same ratio, 200%. All this means is, although the currencies are different, we can see both companies have 2 units of assets for every 1 unit of equity. In other words, because of the use of debt, total assets equals 1 debt plus 1 equity, right? If we broke it down simply, right, it really could be, like 2 billion and then 1 billion debt, 1 billion equity. Both corporations have leveraged up by 200%. So you can see with ratios here that we can compare different currencies. Let's see. OK, let's go over to Excel, do one last one. I bet you when we do these ratios, total assets divided by total equity. And this one, boop, total assets divided by total equity. Now, I put some fancy formatting there, but that's just the meaning of it. And then this doesn't have any formatting, so I'm going to do that same calculation again. I should get 2 here. Now, equals, and the same thing for the pound one. Now, when we make formulas like this, it actually does suck the formatting from the cell references, right? So if I want to see this without just as a number 2, which some ratio people like to see just the number, no formatting, I'm going to Control 1 and then click General. There's the Number tab, Format Cells, Number tab, General. If they want to see percent, Control 1, Number. This is Format Cells, Number, and then Percentage. All right. That was our introduction to ratios. When we come back, the next few videos, we're going to go into great detail about different types of ratios like liquidity, solvency, profit, etc. All right, see you next video.